first session, Global Economic Prospect and the Role of Insurance Industry in Sustainable Economic and Social Development. Please welcome the panelists. Jonathan Dixon, Secretary General, International Association of Insurance Supervisors. Professor Dominicus Savio Priyarsono, Professor of Economics, IPB University. Song U Park, Regional CRO, Allianz Asia Pacific. And the moderator for this session, Olaf Jones, Deputy Director General, Director, Economics and Finance, Insurance Europe.
Hello, and welcome to the first panel. We have quite an act to follow after that, so I hope we can keep you interested. My name is Olaf Jones. I'm Deputy Director General at Insurance Europe, the European Insurance and Reinsurance Federation. Insurance Europe is also a founding member and acts as a secretariat for the Global Federation of Insurance Associations, or GIFIA. As you may have noticed from the agenda, I am standing in for Don Forgeron, who was due to moderate this session. Don is the president of GIFIA. He had started his journey here and was very disappointed to have to return home due to illness. Speaking on behalf of Don and of GIFIA, I can say we are very pleased to be here to support IAIS, who joined GIFIA last year. GIFIA was established in 2012 to increase the insurance industry's effectiveness in providing input to international standard-setting bodies. We represent 90% of the total insurance premiums worldwide, and we're delighted to welcome AAJI as a member and to support the team's efforts here. The panelists will each provide a short presentation, and then we will have a panel discussion followed by audience Q&As. But before I turn over to the panelists for their presentations, I wanted to share some of Don's words on a topic that is a key challenge for our industry, and that is the growing protection gap. It was also mentioned in the introductory speeches. We live in an area of challenges that are becoming increasingly complex. Our changing climate is contributing to severe weather events that are putting more people in harm's way. Changing technology creates opportunities, but it is also creating new threats from cybercrime. Risks are evolving and emerging, and the needs of consumers are changing. More and more, we see a gap between the amount of insurance that makes sense for people to buy and the amount of coverage that they're actually buying or able to buy. And the gap is getting larger. And that's a problem for customers, for us as insurers, and for the economic health of the world. It's a topic that poses a massive challenge for our industry, and it's one that many insurance associations are discussing at national level with their regulators and government officials. It's a topic that GIFIA is spending time on, and we are in the final phases of a comprehensive global study that will define and quantify the protection gaps and look at what drives these gaps. It will also look at the levers and actions, both public and private, that could help reduce these gaps. The study will cover natural catastrophes, cyber threats, retirement, and health. And it's a topic I'm keen to dig in with the panelists in a few minutes. But first, I'd like to introduce Jonathan Dixon. He holds a Master of Science in Economics from London School of Economics and is the Secretary General of the International Association of Insurance Supervisors. Prior to his current position, Jonathan was Deputy Executive at the Financial Services Board of South Africa with responsibility for insurance regulation and supervision. Over to you, Jonathan.
Well, thank you very much, Olaf, and wonderful to be here and to see so many people. I think, as we heard, this is the first real gathering in over 3 years, and at the International Association of Insurance Supervisors, we had our first conference in June after 3 years of being apart, and I know the excitement that comes with being able to meet again in person and to and to exchange views, exchange experiences firsthand. And I'm also very pleased to be here and speaking on behalf of the IAIS to an audience that in many cases we haven't reached before, and it's wonderful to be here in Indonesia and in Bali and speaking to so many of you. So let me kick off with a few remarks. And yes, we have the slide up. But before I do that, first of all, a very big thank you to AAJI as well as Jafia for organizing this event. It is fantastic that we're able to come together during Indonesia's G20 presidency to talk about insurance issues, which, as we've heard, really do need to be front and center as we talk about a stronger, sustainable, and inclusive recovery. Secondly, before I get into my remarks, perhaps a few quick words around the International Association of Insurance Supervisors, the IAIS, because it may be that some of you are not that familiar with the IAIS. The IAIS is the global standard-setting body for insurance. We are a body of around 200 insurance supervisors from around the world, and our membership covers over 97% of global insurance premiums, so we truly are a global association. And importantly, around 2/3 of our membership are actually from emerging market and developing economies. So we have a strong representation of EMDE issues in our membership, and this is very much reflected in our agenda as well. Let me see if I can move on to that. And in particular, I wanted to share with you this slide, which I hope you can see means that many of the issues that are on the agenda of the IAIS at the global level are very much aligned with the issues that we heard this morning in the opening remarks to be of high relevance to the Indonesian market and the Indonesian insurance sector, particularly issues around climate, digital innovation, and financial inclusion. So with that, hopefully that provides some context to a few remarks I wanted to make this morning around perhaps first of all sharing a little bit around the macroeconomic environment in which we find ourselves at the moment and what that means for the role of insurance as being a key building block for sustainable economic development going forward, and the role that supervisors can play in building back better. So, first of all, to start off with a few remarks on the macroeconomic environment. And it is a challenging time in which we find ourselves. So I think many of us were obviously hoping that in the wake of COVID-19 that there was light at the end of the tunnel, and certainly I think as a society we've come through a very difficult time, and we look forward to being able to come back together like we are today. But at the same time, there are dark clouds on the horizon as well in terms of the economic outlook and geopolitical risk. We've seen the likes of the IMF, the World Bank, the OECD downgrade their expectations for the global growth outlook. And we've seen the impact of, in many ways, unprecedented market volatility in response to rapidly increasing inflation and a strong monetary policy tightening response. So, unfortunately, this means that perhaps we have to be accustomed to the fact that turbulence is with us for a while. and I was very interested to hear the remarks from Paogi this morning, and very pleased, of course, that OJK is one of the members of the IAIS, and we look forward to working strongly together. But the remarks around governance, and particularly around the investment function, are obviously key, because I do believe that we're entering a time where attention to not only solvency but liquidity risk, in particular in the insurance sector, and the role of risk managers around that is going to be particularly key. We have come through a period where there's been historically low interest rates and a low yield environment, which has led, as we have found through our own global monitoring exercise, to a period where insurers did pursue perhaps a certain search for yield, an increase in investment in more illiquid assets, an increase in the use of derivatives, often to actually hedge against downward risk in interest rates, and this has created a situation where I think, in a rapidly changing environment with inflation and interest rates increasing rapidly, this also creates the potential for vulnerabilities, as some of those increased exposures and increased derivative activities create the potential for liquidity risk in a sharp snapback scenario. So it's something we're watching closely, combined, of course, with what it means that these changes mean for global capital flows and for emerging markets. It's something I think all of us need to watch closely. But this is the backdrop in which we find ourselves, but I think it doesn't take away from the fact that the insurance sector needs to continue to be focused on the long-term goal around sustainable economic development. Of course, the two go together, because having a financially sound and a stable insurance sector is a key fundamental necessary condition for being able to tackle sustainable economic development, which is why at the IAIS we are at the same time looking at issues, giving great focus to issues of financial stability, but also the role that insurance can play in sustainable economic development. So moving on to that second topic, and maybe a few quick words on that. Absolutely, I think the message is insurance needs to be front and center in this recovery, and that a well-regulated, financially sound, stable insurance sector is a key fundamental building block of real sustainable economic development and making economies more resilient. Given these factors, it is important to sustainably increase insurance penetration and access to inclusive insurance. So I'm very pleased that this is also a focus of the forum. It means growing the market in a way in which insurers can remain solvent and be mindful of prudential issues, but also at the same time be focused on better outcomes for customers, and that means more affordable and more appropriate products in the market. I think here, of course, in Indonesia, there is real potential for growth in that direction. Swiss Re, we heard this morning around estimates of insurance density, and the potential is clearly there for growth, but it needs to be growth in a sustainable way. Last year, one of our partners, which is the Access to Insurance Initiative, published an insightful report on the link between the Sustainable Development Goals, the SDGs, and the insurance sector. They found that while insurance is only explicitly mentioned once in the SDGs, in fact, insurance is relevant for 9 out of the 17 SDGs, where it is possible to set key performance indicators in which insurance has strong potential to advance these sustainable development goals. Given these challenges, I'm very pleased to note that we as the IAIS will start work later this year to consider the steps that supervisors can take to address natural catastrophe protection gaps. And this will build on the work by the IAIS and the A2AI to consider the role of insurance supervisors in multi-stakeholder approaches to address pandemic protection gaps, a paper that we've just recently published, if you're interested in reading that. And this set the stage for work that we plan to do also hopefully under the auspices of Japan's presidency of the G7 next year around issues and including working with the OECD on what we can do to address these natural catastrophe protection gaps. And I will say protection gaps is not limited to natural catastrophes, and we will hear about life and health protection gaps today as well, and those are areas which we also may look to address going forward. I know I'm out of time at this stage. I'm getting a flashing light. So really, I can come back to some remarks around the role of insurance supervisors in this space, but we really do believe that this is an area where we can make a big difference. It's around creating the right regulatory environment. It's putting the right foundations in place. So for instance, risk-based solvency frameworks that we are also doing some work on. And it's about supporting supervisors to understand the role that they can play in bringing about these multi-stakeholder approaches. So let me finish there, and I guess the message is that the IAIS is very much focused on the development of a sustainable insurance sector, and we are available to work with our partners, including the OJK, in achieving that objective. Thank you, Olaf.
Thank you, Jonathan. I'd now like to introduce Professor Sonny Priyarsono, Professor of Economics at IPB University. Sonny is a member of the Central Statistics Agency and also is chairman of the Academic Advisory Board at the Center for Risk Management and Sustainability. Sonny.
Thank you, Olaf. First of all, I would like to congratulate the organizer, AAJI, Indonesia Life Insurance Association, for hosting this very important conference. Thank you very much for inviting me to deliver my brief speech. I am very honored. I am very grateful. In this session, we will discuss two big topics. Firstly, global economic prospect, and secondly, the role of insurance industry. Please allow me to discuss the topic from the point of view of Indonesian context. Ladies and gentlemen, in preparing my speech, I read several reports published by prominent institutions like the World Bank, the International Monetary Fund, the Asian Development Bank, as well as private consulting companies like McKinsey, EY, Deloitte, PwC, and others. In general, they report very similar information and message on the prospects of the global economy, especially in the context of Indonesian economy. To summarize the reports, let me use the framework provided by the World Bank. Slide 2, please. In this diagram, it is perceived that a country's economic performance is shaped by global as well as domestic situations. Two global phenomena, namely the COVID-19 pandemic and the war in Ukraine, are significantly influencing the global economy. The WHO has not declared the end of the pandemic yet, but in most countries, including Indonesia, we have seen good signs of the ending of the pandemic. Naturally, this will be followed by an increase in the consumer's confidence, and in turn, it will significantly increase the demand for commodities. On the other hand, however, China, with which many East Asian countries, including Indonesia, trade important commodities, has not been completely recovered from the pandemic. As a result, the countries experience supply and demand shortage in several important commodities that significantly creates supply as well as demand disruptions. The prices of food and energy have increased, and it will certainly trigger global inflation. Financial authorities of major countries respond the inflation by increasing interest rates. The combination of the phenomena will lead to a slower global economic growth. Most, if not all, reports on global economic outlook mention that Indonesia rightfully responded to the global economic situation with prudent economic and financial policies. Thanks to these prudent public policies, the reports forecast that the Indonesian economic growth rate will reach approximately 5.1% for this year and the coming year. The figure is even better than the growth rate in pre-pandemic year, which was 5.0% in 2019. Therefore, it is safe enough to conclude that despite the probable global recession in the coming few years, Indonesian economy is forecasted to be able to survive with a moderate growth rate. Ladies and gentlemen, let me now proceed to our second topic, which is about the role of insurance industry, again in the context of Indonesian economy. I am very fortunate that last July, I attended an international conference in Lombok in which Mr. Budi Tampubolon, the chairman of Indonesia Life Insurance Association, delivered his speech on market updates and current issues in Indonesia life insurance industry. What I need to do now is to cite the important points of his speech and add some comments and opinion of mine based on my own observation. I would like to use this table on the screen as an approach to discuss the role of insurance industry. I divide the topic into two parts. One is the social and economic development aspects, and the other is the sustainable development aspect. Each aspect will be discussed in two perspectives, which are the current existing condition and the expectation toward the development of insurance industry. My point is that the insurance industry has been very instrumental as a catalyst to economic growth of this country just like the one in advanced developed countries. It provides protection so that households and firms can better manage their risk. This role is increasingly important in the world that is full of volatilities, uncertainties, complexities, and ambiguities. The insurance industry is a vital thread in the fabric of a strong Indonesian economy. Absolutely, insurance industry creates employment, mobilizes funds for productive investments. However, as the case in many other industries in financial sector, the relative contribution of insurance industry to the Indonesian economy is small. The penetration rate of life insurance industry is only 1.2% of the Indonesian gross domestic product, whereas the density is only $54 per capita. These figures are much less than the figures in neighboring comparable countries like Malaysia, Thailand, India, or Vietnam. Considering the fact that the Indonesian economy grows steadily, I can predict confidently that the penetration rate and the density of life insurance industry will soon increase significantly under certain conditions, such as improvement of insurance literacy among Indonesian people and the capability of industry in creating innovative products supported by applications of digital technology and conducive regulations. Recent news about corruption cases in some insurance firms in Indonesia do not help the efforts to increase the contribution of insurance industry to the economy. In my quick observation, several insurance firms still need to improve their governance, risk management, and compliance initiatives. My last point is related with the role of insurance industry in sustainable development. This issue is important and will become increasingly important in the years to come. The government of Indonesia, as well as the Financial Service Authority, have prepared and issued regulation to pursue the targets of green economy initiatives that have been internationally established. On the other hand, in my quick observation, the signs of relevant actions taken by insurance firms have not been widely seen in the media, except for those from very small number of big international players. It is not easy to draw conclusion from my speech. One reason for that is the high diversity of membership of AAJI. As a result, the problems they are facing are also very heterogeneous. To end my presentation, I would like to express my optimism regarding the development of insurance industry in Indonesia. The size of the economy and the steady growth rates of the GDP will sufficiently guarantee the potential rapid development of insurance industry in Indonesia. I wish you all the best. Thank you very much.
Thank you very much. Before I move on to our last speaker, I would just remind all the audience to please do enter your questions into Slido using the code F 22-1. So please do think of your questions and add them ready for the Q&As at the end of the discussion. But now I'd like to introduce Sung-Woo Park. He holds a master's degree in finance and accounting from Hanyang University, Korea, and has more than 20 years' experience in actuarial and risk management. He is Regional Risk Officer for Allianz Asia Pacific. Over to you.
Thank you. So I'm very honored to be here today, and thanks for inviting me. The Bali is actually very special place for me personally, because my wife and I spent my honeymoon in Bali a long time ago. And today, I'm going to make a new memories together with you at the Insurance Forum 2022. Okay? I'm waiting for my presentations to show up here.
We have a slight technical delay.
Okay. So this one's, now you're looking at some word cloud that I searched for some words related to economic outlook, global challenges, or sustainabilities to prepare this my presentations. So I think most of the words are quite familiar with you, so I'm not going to go through the individual. So today also, other speakers, panelists already mentioned about our black swans happening quite often, and this is what currently we are facing globally. So I move to what the insurance can play a role here and more. So insurance company can play a significant role in helping countries achieve in terms of economic growth, social inclusions, and also environmental protections. This can be achieved by the risk transfer, risk pooling, or risk sharings with the household, businesses, and then public sectors. And as a traditional underwriter and risk managers, insurers can facilitate the risk transfer and provide the insurance coverages. So for example, insurance serves to finance the rebuilding of the properties after losses. Also, insurance companies are significant institutional investors, providing the financing to the real economies through the green bond, also sustainability bond, or the impact bond as well. And finally, the insurance as a corporate citizens and employer, their role is becoming important through the pandemic and the increasing the uncertainty. And this requires insurers to be more proactive, provide higher standard of the living and the quality of the life for the communities around them. And this is a strategic focus usually in the global company, as an alliance, as a global company we are focusing on. So I'd like to share some of them one by one. Currently, we are focused on the customer centricities. COVID-19 pandemics put the future into the uncertainty for so many customers. So it's very important for insurance company to put customers' interest and their motivations on their forefront and the core of the actions. And insurers are asked to enhance and personalize the customer engagement and experience more and more. And digital transformations. During the pandemics, many insurance companies in Asia successfully transformed digitally, and they were able to connect with the customers and brokers, business partners remotely. And this has to be continuous as frequency of the interactions, level of personalization have dramatically changed due to these tech players, also the retail giants like Amazon. Insurers need to ensure they stay relevant and provide a truly personalized need-based experience to the customers. Third one is a technical excellence. While the insurers improve its resilience and solvency in recent years, some substantial risks have left uninsured, like cyber security risk, climate change risk, or also pandemics. New risks call for the new product, also new opportunities. However, more innovation is necessary as this kind of the risk, there's an insurability or affordability is still in questions from the insurance point of view. And for the sustainability and ESG and new way of work, I will probably share with how Allianz approach these agendas. For the sustainabilities, so in addition to the traditional role as risk managers and the risk carriers, insurers should expect to be judged by the stakeholders on their response to the broad sustainability priorities, such as climate risk, inclusion, social equity, and transparent governance. So our ambitions as Allianz, we secure your future. This is our hope, our purpose. And also we set some approaches to properly implement our sustainabilities. So we fully integrate sustainability into our organizations and business activities. Also, we align the remunerations, incentivizing the ESG target through the Board of Management. Also, we establish a sustainability reporting, and also we set up the functions, control function to ensure to implement all this sustainability and ESG target. For the ESG framework, as Allianz, we try to embed sustainability and ESGs everywhere. So from the groups, levels, corporate rules, and ESG process, we implement this one across our operations, investment, and also our daily activities. So consistent application of ESG process is quite crucial to mitigate the risk, also capture the potential opportunities when the sustainability trend evolve. And finally, the transparency is very important. That's why the Allianz, we disclose all the sustainability report and ESG report through our website to the public. And finally, through the pandemics, we drove our employees out of office and work from home. And they changed their behaviors, and also they changed their mindset toward working environment. Now, after they come back to the office, it is quite new and efficient time to set the new operating model that works for company and also for the employees who navigating the way of the uncertainty now. So Allianz defined the hybrid work model to reflect the change in the working environment, also embracing the new behaviors, also adopting the change happened. And we developed 9 e-learning modules and provide the employees and leaders along with their onboarding journeys. And this is to cater for the organizational hybrid teams. Like nowadays, not all employees come back to the office. They can select the day to come back to the office. However, they need to connect through the team and customers. So we need to find a way when to discuss and what to discuss when they face-to-face meeting or what we can discuss over the internet. So we define this one through the regular discussions. Also, we had to leveraging the technologies because we now using the old social networks, Microsoft Teams to connect always, whether we work from the office or we work from the home. So this is the way we engage the team, and then we receive the feedback to continue to improve our way of working. So, and then this is not only one-time work, it's an ongoing work, and then we need to receive a lot of feedback from the different employee and customers to further improve this new way of work in Allianz. So constant iterative will be part of the experience of the new normals. We see this is happening, so we focus on to make the employee happy who can also serve our customer best. Thank you.
Thank you very much. And I think that those comments create a nice backdrop for our discussion. I'll remind the audience again to please do prepare and enter your questions into Slido, the code IF22-1. But now moving on to the discussion. The first question I'd like to raise relates to the protection gaps, which we've already touched on and were touched on in the introductory speeches. Research has shown that the protection gap, well, all protection gaps, unfortunately, tend to be increasing, including in life and healthcare as well. We see that people are often just not buying enough insurance. So my question to the panel is, what can and should the insurance industry be doing to minimize the gap? What are you seeing products being developed across the world in developing or developed countries? And what economic trends are you seeing in relation to the insurance gaps? So basically, what role can industry maybe play? And if I start with Sony, if you can lead us into that discussion.
Thank you, Olaf. Yes, you are right. There is very little progress, if any, in reducing insurance protection gap. So I think we need to identify first the root factors of that phenomenon. We can divide the factors into two sides, the demand side and the supply side. On the demand side, the major factors are firstly affordability, primarily in developing countries. Secondly, a lack of awareness, poor financial literacy or general education in the developing economies. Thirdly is product appeal and service quality, which is still a major problem, including in Indonesia. And fourth, policyholder trust resulted from weak legal and regulatory systems for enforcing payment of valid claims. So I mentioned 4 points on the demand side. On the supply side, the major factors are, first is the transaction cost, which is still very high in the industry, especially in this country. Secondly is the imperfect and asymmetric information. And thirdly is the institution. And number 4 is limits to insurability. So the question is, what are effective remedies to the problems? I would suggest several points. One is collaboration of private sector insurance and the governments. The private sectors needs to develop technology and product innovation, takaful insurance, micro-insurance. That is from the side of the industry. From the government side, I would suggest risk mitigation, and then public insurance, mandatory scheme, and backstop provider. This morning I read a news in a prominent newspaper in Indonesia that Indonesia Deposit Insurance Corporation, lembaga penjamin simpanan, has no guarantee the policy holder in Indonesia. So that is, on the one hand, a good news, but we need to discuss the consequence of the new regulation. Maybe that is all my comment. Thank you, Olaf.
Thank you. I think we heard there some roles for both from both on the policymaker side and also on the industry side. I don't know if Jonathan, you have anything to add to that on the policymaker side, supervisory side?
Yeah, thanks very much, Olaf. And I, first of all, to say I very much agree with everything Prof. Sunny said there around the challenges and potential solutions. I think on the supply side, clearly the role of technology and technological innovation can hopefully take us a long way, certainly in the era of big data and hopefully being able to somewhat overcome that information asymmetry problem, because it's certainly in the absence of data, it is natural to be risk averse, and that then means a premium on the price of the cover. So hopefully having more information around the broader customer base can be part of addressing the affordability challenge, also in terms of the affordability of distribution, which is often a large part of the costs of low premium products. So there are opportunities. Of course, there are certain things that need to be guarded against there. So we are at the global level, and I think this is reflective of the focus of many supervisors around the world, looking at some of the challenges of this big data, artificial intelligence environment, which include the potential for unintended bias creeping into and the potential for discrimination if you get more information, which has the potential to undermine the risk pooling aspects of insurance. So these are things that supervisors are looking at. So how to appropriately supervise the new digital age of insurance. But turning to the demand side, and I think really here there are some of the key challenges, and I agree absolutely. Things around financial education, financial literacy are important. But what I would add to that, I think, is I do think financial literacy can take you a certain distance, but I wouldn't want it to be seen as something that takes away from the onus on the insurance providers to try and solve this problem. In particular, I mean, I think one can't operate on a basis of that we should expect customers to understand every aspect of insurance products, because even with the best disclosure in the world, we know most customers don't always read the disclosures. So what that means is, I think insurers have a social license to achieve good outcomes and help with resilience and good outcomes for their customers. So it does mean, I think, a particular emphasis on whether the insurance products that are being developed, marketed and distributed actually meet the needs of the customer. And I know we touched on it, essentially this customer centricity approach. And I think this is where a big challenge actually lies in building a more inclusive insurance sector, which is that you can't just take traditional products and say, well, let me try and sell these to the underserved. You actually have to do the hard job of understanding what are the needs of the customer, what are their circumstances. So for instance, they may have more irregular income flows. So there are some challenges around regular premium payments, for instance, and actually make sure that you are designing products that are appropriate to the needs and the circumstances these customers. So that, I do think that is a nut that hasn't fully been cracked yet. I think there's a lot of innovation happening, but I do want to emphasize the importance of there being not only affordable products, but also appropriate products. And it touches on this point around trust. Because when you're talking about inclusive insurance, you're talking about customers, many of whom will be having their first experience with insurance. It is critical that their first experience should be a positive experience, because if their first experience is a negative experience, they could be put off insurance for life, and you will have undermined the objectives of improving inclusivity and penetration. So I do think that's key. I mean, the last point I'll make, if I have time, is just is around the objectives of supervisors around the world. And I think there is an increasing realization that, of course, issues of prudential soundness and financial stability are key to having more inclusive sectors and addressing the protection gap, because if you have an unstable insurance sector, that's not going to help anyone. But I do think increasingly supervisors are also realizing that there is no conflict or trade-off between financial soundness, financial stability, and inclusive markets, that in fact the two can be complementary objectives, because having a more diversified insurance sector and having an insurance sector that increasingly meets the needs of the broader population, I think are intrinsically good for the growth and the stability of the insurance sector going forward as well, which is why at the global level we are seeing more and more insurance supervisors very much interested in this topic of addressing protection gaps and market development, and the role that supervisors can play in that, which I can come back to if we have time. Yeah. Thanks.
Okay. Sung Woo, I'm going to ask you also to give an industry perspective, but maybe before, just to focus on a particular set of gaps, and that relates to climate risk. We're experiencing increasing number of climate catastrophes, devastating floods in Pakistan, the US experience of incredible storm surges recently, and Indonesia, flooding and landslides have created enormous hardship and problems. And unfortunately, I could keep listing many more. So here, clearly, there is a role the industry has been playing and needs to play, but potentially also in partnership with government. And I'm interested to hear in your views of the particular role insurers can play, and maybe some examples from Allianz on the particular issue of climate catastrophes, but also maybe on the protection gap in general.
As I mentioned that in my presentations, the protection gap, there is some significant risk has been left uninsured, like natural catastrophe risk, also pandemic risk, also climate risk, change risk. This is quite an emerging risk topic, but also because of the affordability and also insurability issues, it's very difficult. Even global insurance, this is a major topic we discuss during our conference always. So the key issue is actually, as you mentioned, one of the key issues is the lack of the risk data and analytics, because sometimes as an insurer, very limited information to put into the model. Sometimes we got wrong information out of this model. So probably industry level, we collect the data. I know there is a data privacy issue, but we can analyze this data and then share at the industry level to put into the model to make the more accurate analysis to find out solutions. There is one I probably suggest usually with our group level as well, to have a more granular data, more broad data from the industry level to make a more efficient outcome from the model. Second one is also the incentivizing from this way to develop in this product and gaps. Currently, we know that all the banking sector or financial reporting sector, we have a consistent rules, like a Basel's, IFRS 17 is coming, all insurance companies to follow. But unfortunately, the solvency regimes you try to implementing the consensus solvency regime, but in Asia, usually still follow the local regulatory regimes, and also some global insurance follow the economic solvency regime. Sometimes I found that the incentivizing a capital allocation is not efficient way to improve the way we spend money to investigate, like the catastrophe product, also climate risk management exercise. We need to allocate more resources and capital to that way, but based on the local regime, it's not incentivized to do so. So probably if you provide the more incentivized through the international solvency regime, we can use this opportunity to make all industry look at the same target, then probably that will be greatly help.
Okay. Yeah, please.
Just want to jump in there. I don't want to miss the opportunity of welcoming the support for a global insurance capital standard, which is obviously a project that the IAIS is very much pursuing at the moment, and getting towards the final lapse on that we should have a global insurance capital standard in place by the end of 2024, which hopefully creates then this common language by which the insurance sector can also understand some of these risks more consistently. I do want to add a little bit of a word on the need for public-private partnerships or a multi-stakeholder approach to addressing some of these protection gaps like natural catastrophes. I mean, of course, natural catastrophes were things that in the past, this was the bread and butter of insurers and reinsurers. They know how to insure natural catastrophes, but of course with climate change and the increased scale and frequency, this is raising questions around affordability and insurability of these risks. And that's why I think supervisors around the world and also at the global level with the IAIS are now tackling this problem of natural catastrophe protection gaps and other protection gaps. I think we are starting to see a number of interesting case studies around the world around these risk-sharing approaches between government and the insurance sector. But we're also thinking around the role of supervisors here. Of course, and it really boils down to, I think, creating the right enabling environment. So having good risk-based solvency, attention to financial stability is important, and having the basics in place. But it's also around checking if there are any unintended regulatory barriers that need to be addressed. So proportionality is key. But also, are there any regulatory nudges that can be done to help? So for instance, you mentioned data, and I know data availability and the need for data sharing is important, and perhaps there's a role for supervisors there to nudge for greater data sharing amongst industry players. And the last thing I would mention is I think we also think about the role of supervisors, because if we're talking about risk sharing between governments and the insurance sector, it's often the supervisor which is the bridge sitting between governments and the industry, who can perhaps play a role in supporting the appropriate design of some of these public-private partnership schemes as well. So those are issues we've just decided we're going to do more work on, and should have a report on that by the end of next year. Thanks.
Okay. Well, one of the questions we'll come to in a moment is exactly the sort of role of insurers and the insurance industry versus the policy making. But before I get to that, I'd mention that in a recent article, the AXA CEO, Thomas Bubel, said that the world is in a multi-crisis environment that we've never seen the like of, because we're facing geopolitical crisis, an energy crisis, environmental and social crisis all at the same time. Of course, he mentioned inflation and the impact that's having on us. And I'm interested in your views about this impact on inflation is particularly having on the industry and on the customers of the industry. So maybe, Jonathan, if you could start off with that.
Thanks, Olaf. And let me maybe focus my remarks particularly on the life insurance sector, because I know that's well represented here today. So, of course, strangely enough, in a way, inflation can be good for the life insurance sector, because if that leading to higher interest rates, then higher interest rates helps on the liability side, because they're more heavily discounted. It can also help on the asset side, because insurers don't have to search as hard anymore for yield, because they can get higher yield from government securities, for instance. But what really matters is, in an ideal world, it would be a slow and steady increase in inflation and interest rates. But where you have an environment like the one we have today, where you're having a sudden shift and a very rapid increase in inflation, and as we've seen, a very strong and rapid tightening of monetary policy and a spike upwards in interest rates, this can create real risks, which I touched on a little bit in my presentation. But of course, we are conscious of the vulnerabilities at the moment, as I said, because we did see an increasing trend of investment in level 3 assets, the more illiquid assets, which of course creates a liquidity risk. We've seen more derivatives activity, hedging against downside interest rate risk, so it can create real problems in terms of margin calls in the event of a rapid increase in interest rates, again creating liquidity risk. We saw an increasing trend in cross-border reinsurance, which is sort of exchanging underwriting risk, but it can also increase counterparty credit risk in volatile times. So there are a range of vulnerabilities at the moment, which are then further exposed in this snapback environment, and this is something that supervisors around the world are giving particular attention to at the moment. Of course, in a high inflation environment, that also leads to a cost of living crisis, as we're seeing in many countries, and this presents challenges also for lapses and surrenders, and what that means for profitability of insurers as well. So these are challenging times in a high inflation, rapidly changing interest rate environment. So what can supervisors do? I think heighten monitoring. So we are certainly doing that at the global level as well. And also, what can supervisors do around the supervisory response, and we are also looking at helping to support the global level exchange between supervisors from around the world on what their supervisory response is to this very rapidly changing new environment, including things like the use of liquidity risk stress testing, and exchange of good practices there. And of course, I think heightened engagement with the insurance industry as well on how they are managing these risks. Thanks.
Thank you. Sony, from an academic point of view, I guess, and Professor of Economics, you may have some views on inflation. What do you think the outlook is, and do you have any views on the impact on the industry?
Yes, I would like to add some small points to what Jonathan has already mentioned earlier. So, of course, inflation will decrease the affordability of the consumer and hence will hurt the demand. But in developing economies like Indonesia, the consumers of life insurance are those with medium or high income. What I mean is that the inflation will hurt the demand side, but not necessarily very significant. So I'm confident that at least in the few years to come, the demand will be hurt, but not very significant. That's my personal opinion. Thank you.
Okay. Thank you. Yeah, I think it's interesting that, Jonathan, the way you noted that, of course, the impact is not necessarily bad for certain products, and there's a difference between life and non-life. I think it's also worth noticing in Europe there is a real cost of living and affordability problem as well now, and I think that's linked not just inflation but also the cost of energy, so there's a lot of factors going on. But moving on to my last question, and that's relating to this issue of the role played by the industry and versus the policymakers in terms of how we can achieve the G20 theme of recover together and recover stronger. Just wondering whether you have any particular views on the balance, and I'll bring in one of the questions from the audience, in fact, here, because this relates to financial literacy, and the question was, there is a clear need to increase financial literacy. When are we going to invest as an industry to support this? Who should lead it and how? I think that's another question. Is that the industry's responsibility, or is that a policymaker's government responsibility? So maybe, Jonathan, if you can give views of the balance of responsibility overall, but also in response to that question.
Well, thank you very much. And first of all, and just repeat the message, of course, financial literacy is very important, and there is important work that happens in various bodies, and I can pick out the OECD, for instance, who've done extensive guidance around financial literacy programs. I think there are differing views on whether this is a core objective of supervisors, but I will say there are an increasing number of supervisors around the world who do see this as an important part of their mandate. But to the question of whose primary role is it, and maybe I can talk a little bit from my previous experience in South Africa. I mean, my personal view is that the primary responsibility really does lie with the industry itself. It is not only important for social development and sustainable development, but also good for the industry itself to have financially aware and well-informed customers. It goes also with this earlier question around trust. You can build trust by also having better educated customers. And that's why I think certainly in South Africa we actively encouraged industry-led initiatives around financial literacy, and particularly at the industry association level to bring that together. That said, I think it is the role of the supervisor to provide the framework for that and the probably setting the important strategic priorities together with government, and let's say setting parameters or guidelines for financial literacy efforts, because of course one of the things that can become a tricky area is the line between financial literacy programs and marketing programs for particular products or particular providers. So you certainly need clear guidelines, I would say, from the supervisor on issues of that. Thanks.
Yeah.
I can add from the industry view. I think I agree with you, and also I think the industry level, they need to leverage like best practice sharings. I mean, in Allianz, we have 10 countries, 15 operating entities. Some countries selling more unit-linked, investment-linked product that customer need to know what their risk they are taking from them. So they usually provide more information, educations, customers. So these countries usually share their practice with a company who want to launch their unit-linked product into the market, so they can improve their customer literacies. So I think in the country level, if there's a global companies, they already implement all know your customer or retail risk, conduct risk framework to improve the customer disclosure and then help them to understand the product. They can, industry level, invite these global insurance companies to industry association meeting and then share the best practice, then learn how they can improve that customer financial literacies, then they can implement across the companies.
May I
Yeah,
add something?
please do.
In my opinion, we need to have collaboration between the government, the authority, and the industry. But if we talk about the Green Economy Initiative, in my opinion, the government must take the lead. So the government must lead the initiative through creating and enforcing good regulations effectively. The government must be the leader in creating green economy. In other words, it is not rational to assume that private sector alone could autonomously execute efforts to create green economy. But I should not talk much about this issue because we will exclusively discuss this topic in the next session.
Yeah. Okay. One thing to note is in the Jafia study that we're doing, we'll be looking at the different levers, and we actually look at some case studies of where countries have tried to initiate financial education and seen some success in it. So looking forward to be sharing that with everyone soon. But I think now we're going to move on to the Q&A section, and we have some questions from the audience. What I would say is also encourage you to take a look at the questions. If there's any that particularly interest you, to give a thumbs up so we can see the most popular questions. But I've already covered one of them earlier about financial literacy. But there's one other question that's come up with a number of support, and that's about ESG. And I think I'll ask Song Woo, because the question is how ESG impacts the industry and how insurance companies can cope with ESG. Now, you gave an indication of some of that, I think, in your slides, but maybe you can give a short view on how your group is coping with ESG.
Okay, ESG topics it's quite a challenging topic. As I discussed yesterday, it's not a short-term goal. It's like a mid to long-term goal to implement this ESG target as insurance companies. So we start with clear our corporate rules based on what we want to achieve, and we apply this rule across our activities. So all these activities, whenever there's an investment, also operations or procurement, we already know what are the ESG-related factors, and we already make a decision regarding whether these activities meet with these ESG factors or not, and then we make the decisions where we want to go for this make a decision or not. for the investment, when we introduce our investment asset, we already screened all the ESG factor, and if we fulfill this ESG, then we accept that it's an investment. However, in the business as underwriters, it's quite challenging. Investment, we can select the investment, whether meet their all ESG risk or ESG factors, but the business, when we walk away from the one business because they are not meeting this ESG risk, but there's no alternative sometimes. So there's only one provider of the electricity, one owned whole hydro dams. If we apply this ESG factor, it's not meeting, then we have to walk away based on this principle. However, there's no alternatives. So ESG, we always need to also balance the environment, also social impact and governance impact. So we always need to think balance of the economy, the environment and social impact when we make the decision on the ESG. That is our current learnings path.
I've got a follow-up question for you because I think it's quite popular, and the question is, could you elaborate more on the remuneration incentivizing ESG for your board of management and whether there's any evidence of positive impacts?
In our planning and strategic dialogue, we have a very lengthy planning processes for the all operating entities. We provide them a list of the ESG and sustainability factors as their target. So all entity has to report based on the progress of these ESG factors, like the waste usages, also participation into the ESG at the local level. All these factors has been embedded into their planning, and then based on the planning, every quarter they monitor and report to the group and regional office. We assess their progress, and then in the remuneration or compensation, we reflect that progress based on the planning is a commitment, and then how they meet this target, and we reflect into remunerations. At the beginning of the planning session, we already agree on the target. It's not a top-down target. Usually there is a bottom-up target as well. We just set the factors, and then we ask them how much they can meet these factors. There is a different level of the countries, and then based on their commitment compared to the actual progress, we reflect their remunerations.
Okay. Any comments on ESG from yourselves? No?
Yeah, just very briefly, and I was very happy to hear the responses there, because I think it is very much about, how do you embed ESG into the organization at every stage of the business decisions. And of course, remuneration can be a very important driver of behaviors. So it's good just to say from the IAIS side and what we're looking at the global level. So of course, the E in ESG on the environmental side has been a big area of focus for us amongst supervisors over the last couple of years, particularly climate change. And there is a lot of work that's been happening at the IAIS and amongst global insurance supervisors around what they would like to see insurers doing in this area. So it's around clearly very important to build it into risk management, but also disclosures and thinking about these factors in all the decisions. But just to also flag that I think our attention is also moving to the S in the ESG. So we already had quite a strong focus on financial inclusion, which is also part of sustainability, the S, and customer centricity. So good customer outcomes, I think, is an important aspect of that S, the social side, and we very much emphasize that customer centricity should also be embedded, and your performance in terms of customer outcomes should be one of your remuneration indicators as well. But lastly, I think lately, we're also bringing in aspects of diversity, equity, and inclusion into the S of ESG. So since this goes a little bit beyond financial inclusion, I think financial inclusion is making sure that everyone has access. The diversity, equity, the DEI aspect is sort of perhaps giving particular attention to more vulnerable or excluded groups, and seeing how your actions as an insurer are particularly targeted at addressing those previously excluded or underserved markets. There are some good case studies around the globe. I know we have Beth with us, so I particularly want to flag the efforts of the National Association of Insurance Commissioners in the US around race in the insurance sector as well, and actively engaging and addressing how discrimination against particular racial groups is being addressed in the US as well. So that's, for me, is also an important aspect of the S of ESG. Thanks.
Yeah. Yes, indeed, a lot of focus has been put on the E in climate, but there are many other challenges ongoing and ahead of us to get the whole of the ESG framework working well. We have time for one final question, and I think that would be to Sunny. Do you have a view on some of the specific enablers or relaxations we can make to accelerate the penetration and sustainable development of insurance in Indonesia?
I think we have already discussed the points of what we can expect from the role of the government. So the government needs to pay attention on how to improve the education for the people, to increase the financial literacy. And it has to be made within a clear scheme so that the industry can follow the guide from the government. I don't have specific points. I have no experience in the industry as a practitioner. Maybe Mr. Park has more experience or expectation on that.
Anything to add? Yeah, please.
Just in the interim, I think it is a sort of a twin track because and I don't want to be running the risk of looking to give advice, but I think the twin track of, on the one hand, looking to how to make it easier to do business, and so being supportive of things like innovation, and particularly technological innovation, and proportionality of regulations is important. But the second part, and I think this was touched on by Pa Ogi this morning, is accompanying that with making sure that the basics of strong governance and risk management are in place with insurers as well. And so I would certainly encourage steps in that direction, because again, back to this issue of trust, you can be making fantastic progress in improving penetration and use of insurance, but it just takes one sort of scandal or one failure or a prominent failure to undermine that trust. So I think it's a combination of making it easier to do in insurance business, but also making sure that it's done in a very responsible way. Thank you.
So I think about that based on your comment, the relaxations of some of the rule. I mean, when you go to some countries based on the rule-based countries, whenever we want to apply the new business models, as an incumbent insurers, you have to follow a lot of rules to fulfill, to make some trial and error business model. But for the insurtech company, fintech company, for them to test the water is quite easier compared to the incumbent insurers. So one example, one country recently, the regulator put some sandbox rules, some areas to allow the big insurance companies to also tap the business there. And then whenever they work together with a tech company or fintech company, insurtech company, they allow them to test a new business model without following the old rule, and then they can run the small-scale business and try, and then later they can report based on their learning and experience to develop and then ask for their permissions. So I think this is good one way to implement in Indonesia to further relax or increase the penetration with a new business model. Also, looking for the way to in the sustainable development area as well.
Yes, I think it's a real challenge getting that combination of strong regulation, which creates the trust, but still the flexibility and the proportionality that allows companies to innovate and develop and offer effective solutions. So, but I think that we've reached the end of our time. In fact, we're a little bit over the originally scheduled timetable, so we'll be wrapping up there. I think we've covered such a wide range of discussion points. I'm not going to try to summarize, but I think I will maybe just end on one note that Sunny raised right at the beginning, and that despite all of the challenges we're facing, there is huge potential, particularly in Indonesia, and that I think you remained optimistic about the future ahead, what insurers can do, and I think that's a great note to finish on. So thank you, Jonathan, Sunny, and Sungwoo. Thank you very much. And thank you to the audience.
All panelists are requested to remain on stage to receive token of appreciation. We would like to invite Mr. Fauzi Arfan from IAIS board to come on stage to present token of appreciation.